Hey everyone, FinTech here, and in this video I'm going to be walking through my top 10 stock positions for 2022. These are all positions that I personally hold in my stock portfolio, which despite the recent drop in tech stocks is still up around 28% for the year. I'm going to walk through exactly which stocks I'm currently investing in, show you exactly how much money is in each stock, and talk about why I picked those stocks to invest. At the end of this video, I'll also talk about any trades that I made in the past month, including one new company which could revolutionize the way online businesses are built. So hit the like button if you appreciate me showing you all these details. My goal is to be as transparent as possible, and I think some people can get a lot of value out of these kinds of videos. But let's not waste too much time, and let's pull up my Charles Schwab brokerage account and start going through the different stocks. So we have pulled up here my Charles Schwab account, which if we go to the 1 month view, we can see is down around 20% for the entire month. Now this is mostly due to just a general drop in all kinds of tech stocks as well as high growth stocks, which as you'll see, my portfolio is very exposed to. But if we back this out a little bit to look at just the last year to date, we can see that Charles Schwab shows that I'm up around 48% year to date. And that's not without a couple bumps in the road as we went. We can see that in early February/March, we saw a pretty big drop. We also saw another drop around May. And then of course, we've seen the most recent drop from around the beginning of November until when I'm filming this video, which is around mid-December. Now, this latest drop is the largest drop that I've seen since the beginning of the pandemic over a year ago. But honestly, all of these drops, when they happen, feel like they could go on forever. And so even though my portfolio has dropped substantially in the past month, I'm not planning on panicking or selling out of the market or anything like that. And if we back this out to say a 2-year view, we can see that over the long term, you can still outperform the market if you're investing in really good companies. Now, these numbers here aren't exactly accurate. For example, this 2-year change is actually closer to around 110% for my portfolio, but Charles Schwab calculates any money you add into the account as if it was a gain, so this is a little inaccurate. And same thing for the year to date. This shows that I'm up 48% for the year currently, but that includes money that I added since the market dropped in November, so this is really up closer to around 28% for the year right now. But let's now go and look at the individual stock positions. So my first and largest position that we're going to look at is a company called Datadog, which I currently own 444 shares of at a value of just under $75,000, and that's off an initial cost basis of $37,000. So this has returned almost $38,000, which is over a 100% rate of return. Datadog is a data company. They let companies look at their infrastructure, their applications, and their security all through a single pane of glass. And then they can use that data to more effectively run their business. Datadog is an absolute powerhouse of a company. They've been growing at around 70% per year while maintaining ridiculously high margins, and yet they have been valued lower than a lot of the other high growth stocks that are out there in the market, which is partly why even though high growth stocks in general have dropped, some by as much as 35%, Datadog has had a relatively small drop so far, closer to around 15%. This is my highest conviction position in the market right now. But next up we have CrowdStrike, which I own 263 shares of at a value of $54,000, and that's off a cost basis of just under $36,000. So this in total has made about $18,500, or over a 50% gain. CrowdStrike is a security company that offers cloud-native security. Now right now there are a lot of legacy security companies which are not doing that great, but when you look at the big 3 cloud security companies right now, Palo Alto Networks, CrowdStrike, and SentinelOne, they are all rapidly gaining market share from those incumbents as companies realize in order to protect cloud workloads, it makes sense to go after a cloud-native company. CrowdStrike has been growing over 70% per year for a very long time at this point, and they have ridiculously high margins just based on the fact that everything they sell is pure software. Now, right now, CrowdStrike is starting to see some competition from smaller companies like SentinelOne, but right now, they still have, in my opinion, the best product on the market, and they seem to be growing pretty well, so the numbers are supporting that for now. Plus, security in general is becoming more valuable than ever as more of our lives become digital, and attacks on that are very, very devastating. So the company's doing well individually, and just the general market is moving in the right direction for this type of company. So I'm very happy with this as my second largest position. But up next we have Cloudflare, which I own 257 shares of at a value of $35,000, and that's off an initial investment of $16,500. So this is over a 100% return at $18,000 returned. Now Cloudflare's goal is to make the internet itself work better. They They started out as just a CDN service, basically hosting websites for other companies, but then they realized they could use their position hosting websites to optimize the experience for good actors or make it harder for bad actors to attack the website. They later expanded this into changing the way the internet itself works, launching Cloudflare workers to let people run computing workloads on the internet, as well as more recently launching new products that tie in directly with the idea of the metaverse, as well as blockchain and accessing those kinds of endpoints. In terms of all the companies on this list, Cloudflare might be the most innovative and the best at launching new products. The only reason this isn't my largest position overall is because they were valued very highly after a rapid run-up over the last couple months, so I had trimmed down my position a little bit, and then with the recent drop, they've dropped around 35% in the past month, which has brought this down to my third largest position overall. Now you'll notice that these three largest positions all have a 2 next to them, and that's because I hold these stocks both here in my Charles Schwab taxable brokerage account, as well as in my Vanguard Roth IRA account, which I contribute $6,000 to every year so that it can grow completely tax-free throughout the year. Number 4 on our list is ZScaler, which is another security play, which I own 60 shares of at a value of $17,000, and that's off an initial investment of $16,500, so it's made around $1,000. ZScaler is an expert in zero trust security. In a traditional security model, it was all about the network. You would basically build a really strong firewall around your company's network and hope that all the bad guys stayed out. But once they got in, you were kind of compromised and they could go around and mess things up. With ZScaler, they assume the bad guy is already in your system, so they make it so that anytime two things have to connect with each other, there's no automatic trust between those and they have to be verified. Zero trust is becoming extremely important as more and more things move to the cloud, and so ZScaler has done very well over the last couple years. Additionally, both ZScaler and Datadog were recently added to the NASDAQ 100, which are the 100 largest tech stocks in the country. This to me shows that the market is starting to realize the value of some of these companies. And next up we have ZoomInfo, which I own 194 shares of at a value of $12,500. And this stock I invested just under $12,000 in, so it's made about $500 in profit. ZoomInfo helps salespeople connect with the people they need to talk to inside companies. So it's a win-win because the salespeople don't waste their time knocking on doors, and the people they're selling to don't have their time wasted because the people who reach out to them have products that are actually useful to them. ZoomInfo is growing very quickly, and I've been seeing them pop up all over the internet recently, so I'm pretty happy with this as a mid-sized position for me. Next up, we have Upstart, which I own 53 shares of at a value of $8,000, and that's off an initial investment of $18,000. So in total, the stock is down around 10 grand. Now that's a little bit misleading because originally I had a much larger position in Upstart, and then I sold out of a bunch of it after it dropped around 40%. So this is looking at a lot of the shares that I bought when they were more expensive, which makes this skewed a little bit worse than it actually is. Upstart is an AI company that is trying to apply that technology to the lending space. While a traditional lending company evaluates someone based on a single number, their credit score, Upstart uses thousands of different parameters to feed into an AI model, which means they can offer more loans to different kinds of people or offer the same loans at better interest rates because they can more accurately predict the risk of offering those loans. Upstart has also managed to increase the conversion rate from the people who ask for a loan to the people who are actually offered one, so they're creating a lot of value in the industry, and they're starting to partner with some big banks to actually offer their services. So Upstart, unlike a company like, say, SoFi, doesn't keep any of the risk of the loans on their balance sheet, but they get all the benefit of actually making the loans and collecting fees from that. Honestly, Upstart has been beat down so much recently that this is probably going to be one of my targets to contribute to over the next couple months. But after Upstart, we have C Limited, which was also a stock that was hit pretty hard the past month. C Limited I have 23 shares of at a value of just under $5,000, and that's off an initial investment of $5,600, so it's about $700 in the hole so far. C Limited you can kind of think of as the Amazon of Southeast Asia. It's really 3 businesses rolled into one. You have Garena, which is their mobile gaming business, you have Shopee, which is their e-commerce business, and you have C Money, which is their financial services business. Now C Limited has been growing very quickly, but it was never my largest position just because the e-commerce business is so difficult to compete in. But C Limited has been absolutely beat down by the market over the past month, dropping 35% despite the fact that it's not quite a full tech company and it's not quite a full hyper growth company either. Honestly, this company has a lot of potential with its expansion into Mexico and Brazil, and so I'm going to probably have to take a deeper look at this to figure out why it dropped so dramatically, and if there's no good reason for it, probably buy more. After that, we have Amplitude, which I own 65 shares of at a value of $3,200, and that's off an initial investment of $3,200, so it hasn't really made any money. Amplitude essentially offers a data analytics service for people who are building a digital business. So let's say I build a mobile app. How do I know what features in the app are driving the most value? Well, with Amplitude, I could find some feature that's maybe buried somewhere in the app, and I noticed that when people use that feature, they become twice as valuable as other customers were before. So I can take that feature and I can make it a lot more prominent in the app. And Amplitude as a company was actually founded because the founders were looking for a tool like that for their previous business. Now this is a relatively new company for me, which is why I haven't put that much money into it, but this is one I'm going to be looking into more over the next couple months. After that, we have SoFi, which I own 119 shares of at a value of $1,800, and that's off an initial investment of $2,500. So this one is in total negative. SoFi is a fintech company, and they have their fingers in a lot of different pies. They do student loan lending, mortgage lending, they have a mobile app, they own Galileo Technology Platforms, which is a payment processor, and they have been growing their total number of products as well as members fairly quickly over the last several years. Now, SoFi has always struggled a little bit with its association with SPACs as it went public under Chamath Palihapitiya, but unlike a lot of other SPACs which have really floundered after they went public, and some of which turned out to be mostly fraudulent, SoFi has actually done pretty well from a business fundamentals point, but the stock price hasn't always matched that same performance. This is a small position for me just because of that mismatch between the stock price and the company fundamentals, but from a fundamentals perspective, this is a really strong company which has a lot of catalysts going for it in 2022, which I made a full video on this channel. And then last up, we have AFRM, which I own 14 shares of at a value of $1,300, and that's off an initial investment of $2,000, so it's lost about $700. AFRM operates in the buy now, pay later space, where essentially when you check out on a website like say Peloton, rather than paying the whole amount up front, you can choose to pay that over time via a loan. This is essentially a replacement for credit cards, which a lot of studies have shown millennials are very wary of using. Now, I originally bought into AFRM because the business model makes a lot of sense to me, but the only reason I didn't make it a larger position is because there seemed to be a disconnect between their stated goal of helping people financially and offering a buy now, pay later service, which really I don't see any financial benefit to using, which is supported by data that shows that a substantial number of people who use buy now, pay later services do so because their credit cards are already maxed out or to buy things that they couldn't afford otherwise. But while that's a list of all my different positions, I also told you that I would let you know any trades that I made in the past month. So if I pull up my Patreon, I can look at a couple buy and sell alerts that I issued. So I bought 25 shares of CrowdStrike worth about $5,600 at the end of November, and I also bought 26 shares of ZoomInfo worth $1,800. And this was mostly using money that I gained from selling some of my Cloudflare position earlier in the month, just because I thought that stock had run up a little bit more while these other companies had not run up quite as much. Additionally, if we go to my most recent trade alert, just earlier this week, I first bought 65 shares of Amplitude worth $3,200. So this is just a completely new position, which I did not own last month. And while my portfolio is down substantially for the month, I still have a lot of faith in these companies that I'm already investing in. So I'm not making any major changes to my portfolio in the coming weeks. I'm also not going to try to time the market by moving a substantial portion to cash, because studies have shown that staying in the market long term tends to outperform moving in another market over time. But let me know if you own any of these companies or if you've looked into any that you think I would be interested in. If you'd like to support the channel, you can check out my Patreon, which I showed you a little bit earlier. So you'll still get all the same information if you just watch this channel, but you'll get it a little bit quicker on Patreon, and you can ask me direct questions if you want. Don't forget to like and subscribe, and I'll see you next time.